Hello friends, this is Hatim Rampurawala, and in this video we'll quickly revise SA 520, that is Analytical Procedure. Okay, so it has been divided into two parts basically: meaning and the nature of the analytical procedure, and audit procedure relating to analytical procedure. Okay, so we'll first cover meaning and the nature of the analytical procedure. So this would be a quick recap. Basically, we'll try to cover it into 5 or 10 minutes, and under 5 to 10 minutes. Okay, so meaning and the nature of the analytical procedure: evaluation of the financial information. So what is analytical procedure? We auditor try to evaluate that is evaluation of the financial information through the analysis of the relationship among both financial information and non-financial information. So we try to analyze the relationship among both financial and non-financial information, we in the sense auditor. So it is evaluation of the financial information through the analysis of the relationship among both financial and non-financial information, and also encompass such investigation as is necessary of identified fluctuation or the relationship that are inconsistent with the other relevant information, or that differs from the expected value by the significant amount. So analytical procedure, it is a consideration. Analytical procedure is consideration of the comparison of the financial information. So what the auditor basically do is compare the financial information with the comparable information of the prior period, with the anticipated results of the entity, with the auditor's expectation, compare it with the industry information. So speak it without saying, that is a consideration of the comparison of the financial information with what four things: that is with the comparable information of the prior period, with the expectations of the entity, with the auditor's expectations, anticipated results of the entity, auditor's expectation, and the other relevant, that is industry, that is comparison with the similar industry information. And the analytical procedure is the consideration of the relationship among that is the element of the financial information, that is we compare financial element with financial element, that is then consideration of the comparison of consideration of the relationship among element of the financial information or the financial information and the relevant, this what is important, that is relevant non-financial information. We don't compare each and every financial with non-financial information, not all non-financial but only the relevant non-financial information. So we will again quickly read this. That is the meaning and the nature of the analytical procedure: evaluation of the financial information through the analysis of the relationship among both financial and the non-financial information, and encompass such an investigation as is necessary to identify fluctuation or the relationship that are inconsistent with the other relevant information, or that differs from the expected value by the significant amount. In this essay is little tricky based on the wordings, so at the end you have to mug up the wordings. Then analytical procedure is a consideration of the comparison of the financial information with the comparable information for the prior period, with the anticipated results of an entity, with the auditor's expectation and the similar industry in the information, and consideration of the relationship among the element of the financial information or the financial information and the relevant non-financial information. Okay, we'll move on now. Auditor's procedure. See, this is also an important answer as such, and this also we basically need to mug up only. The wordings are little tricky. So okay, so first auditor procedure. First, determine the suitability of the particular substantive analytical procedure. Suitability of the particular substantive analytical procedure. Okay, following factors require consideration. First, substantive analytical procedure, that is SAP. Substantive analytical procedure are more suitable to the large volume of the transaction, tending to be predictable over the time. But the suitability of the analytical procedure is influenced by the nature of the assertions and auditor assessment of the analytical procedure effectiveness to identify material misstatement. So first point, it is like it is more suitable to the SAP is more suitable to the large volume of the transaction, tending to be predictable over the time. Then but second point, but suitability is influenced by the nature of the assertions and the auditor's assessment of the analytical procedure effectiveness to be identify material misstatement. Then third is, in some cases unsophisticated predictive model may be useful. So unsophisticated predictive model is also used in is also a factor basically to determine the suitability of the particular substantive analytical procedure. Then different type of analytical procedure provide different level of assurance, and the particular substantive analytical procedure may be considered suitable. So particular SAP may be considered suitable when the TOD, that is test of detail, are performed on the same assertion. So if the test of detail are performed on the same assertion, then the particular SAP may be considered as suitable. So there are 5 points. First is substantive analytical procedure are more suitable to the large volume of the transaction, tending to be more predictable over the time. Second, but the suitability of the analytical procedure is influenced by the nature of the assertion. By the nature of assertion and auditor assessment of the analytical procedure effectiveness to identify material misstatements. In some cases, unsophisticated predictive model may be useful. Different types of analytical procedure provide different level of assurance. And the fifth is particular SAP may be considered as suitable only when the test of detail are performed on the same assertions. Then there is a second concept, that is evaluate the reliability of the data. So following factors affect the reliability. First, source of the available information, comparability of the available information, nature and the relevance of the available information, and the control over the preparation of the information. Then develop an expectation of the recorded amounts or the ratios. So first, auditor will develop an expectations of the recorded amount and the ratios, and also evaluate whether and also evaluate whether the expectation is sufficiently precise to identify the material misstatement. So whether that expectation which the auditor has developed of the recorded amount and the ratio are sufficiently precise to identify the material misstatement. Then find out the differences between the recorded amount and the expected value. So it is written that determine the amount of the differences of the recorded amount or from the expected value that is acceptable without further investigation. Then investigating the result of the analytical procedure. So the difference, basically the result of the analytical procedure, that we have to investigate. If an auditor identifies the fluctuation or the relationship that are inconsistent with the other relevant information or differs from the expected value. So if an auditor identifies the fluctuation, so I remember the word, if an auditor identifies fluctuation or inconsistency that or the relationship that are inconsistent with the other information. So if an auditor identifies identifies the fluctuation or the relationship that are inconsistent, so fluctuation or the inconsistency with the other relevant information, and that differs from the expected value by the significant amount, and that differ also from by the major, that is significant amount, the auditor shall investigate such differences by inquiry of the management. So how they will investigate into such differences, that is by inquiry of the management, and perform the other audit procedure as necessary in the circumstances. So the third point, fourth and fifth, I will repeat it again, that is develop an expectation of the recorded amount and the ratio, and evaluate whether the expectation is sufficiently precise to identify the material misstatement. Determine the amount of any of the difference of the recorded amount with from the expected value that is acceptable without further investigation. And investigation of any result of the analytical procedure, that is the auditor identifies the fluctuation or the relationship that are inconsistent with the other information, and that the difference is the difference from the expected value that differ from the expected value by the significant amount. Auditor shall investigate such differences by how they will investigate: first, inquiry of the management, and perform the other audit procedure as necessary in the circumstances. So by this we are done with this 520. Thank you for watching the video.